here you can find this morning I uploaded the syllabus for our module. So here you can see my email. Okay, my office is in building number 2, room 4047. Tomorrow, my office hour is going to be from 12:30, 11:30, 12:30. But every week, I will communicate to you if there are any changes. Because sometimes on Wednesday, I cannot have any office hours. So tomorrow is going to be Wednesday. Oh, sorry, tomorrow is going to be. I'm going to have the office hours from 11:30, 12:30, 1 o'clock. Then the next week I will let you know in advance. Every Tuesday I will let you know when. Okay, this year there are some important changes. Okay? I don't. So then we'll go. Final exam, 100% marks. So this year, please silence. Guys, silence. This means that you don't have any group assignment for my module this year. The reasons are the following. First of all, we will do together some exercises, some case studies in class. So we will do some analysis of real data together. So you don't need to do anything by yourself alone. Second, I will give you some papers, some published papers to read in advance from literature, and then we will discuss in classes together. So you don't do anything by yourself. Last year, what I noticed is my module is going to end the first week of January. This means that if I ask you to do the group assignment, you will not have time to study for the exam. So I want that you focus only on the exam. Forget about the group assignment. Okay? But I promise you that we will do literature, we will revise the literature, we will do analysis together in class. So you will gain still analytical skills, you will develop the skills that you were supposed to develop through the group assignment. The exam is going to be different from the previous year. This means that you will have so you will have 50% Science! Okay, so 50% of the total score is going to be given by multiple choice questions. Multiple choice questions will be theoretical. So this means that I will ask you some definition, I will provide you with some answer, and you have to pick up the right answer. Simple. Okay? I don't penalize you. So if you don't know the this means that if you do if you will make some mistake, I will not take any score from you. Okay? In part B, so here the maximum that you can get is 50%. If you will make some mistake, suppose that you will make mistake, you will not answer a question, you will lose some mark. Each question carries on 2.5 marks, something like that. Okay, so I don't know, you will have around 25 questions, something like that, the multiple questions. So this means more or less 25 questions. Each question more or less. Okay, maybe you have something. Okay, more or less. For part B, you will have 3 exercises. Okay, so you will have I don't know, part A, part 1, part 2, part 3, and here you will have some question 1.1, question 1.2. So you will have, in part B, you will have 3 main questions, and you just have to decide which question you want to answer. In each question, you will have some sub-questions. So, and this part will only cover exercises. Okay? Simple. I don't, so you don't have any choice here, but you will have choice for this part. Because you can decide, okay, I want to do this question, I want to answer this question, so you will answer only this question. So you have choice for this sentence. Okay? So at the end, your mark will be the sum of your results for multiple choice question and exercises. Okay? Do you have any questions? Questions? Yes?
What will do
Sorry?
so what will do
The multiple choice question included, let's say, 25 questions. Each question, so you have to do everything. So I don't understand. You just have to answer. Sorry. So here you will have the hours to do all the exam, okay? So you can start from the multiple choice question, you can start from the exercise, I don't care. You will have 2 hours to do to answer all the questions. No, sorry. Okay. Now the exam is going to be in January. Okay, not before Christmas, because we will have 5 weeks now, and then we will have a week at the beginning of January. So in January we will do some exercises. We will do some, exercise multiple choice questions to be solved, and we will be ready for the exam. And then the exam is going to be, I think it's going to be the 2nd week of January, but I still don't know the date. So you will know pretty soon. So you will have time to get ready and prepare. Okay? So before Christmas you don't have any examination. Yeah? Other questions? Yes. The last year results, the problem is the last year results is different, it's completely different. So I think that last year results was something like, on average, 62, 63, something like that. But please, don't look at the previous exams. Don't look at the previous statistics. Why? Because maybe the last year the students were very good. This year, I don't know, you are not good enough, so you will perform not good as the students of the previous year? Or is it possible the opposite? Maybe every one of you deserve distinction. I will give to every one of you distinction, but it's very difficult, but in any case, so don't look at the previous statistics. Every year, the students are different. So you have, when you, as a teacher, you know, what I keep in mind, that students are like wine, you know, the wine that you drink. Sometimes the wine is good, some year, some other year is not good enough, or maybe some year is fantastic. Then the exam this year is very different, as I said. You don't have the group assignment, and then you have multiple choice questions. Last year I had open questions, and then exercises. So it's different. So I cannot compare what you will do this year with what was done by previous students. But let's say the content of the module is the same. So I would expect, yeah, I mean, even though let's say the structure of the exam is a bit different, and yeah, but the arguments are all okay. Other questions? Questions? Yes. No, allora, I don't, as I said, don't look at past exam. I don't want to upload any solution of past exams. I really don't, I never done this. Simply because I will do exercises together with you every week. So every week here in class we will do exercises together. So if you do the exercises that we do in the next weeks, you will not have any problems. And I will give you questions and solutions of everything.
So for the review, we just look at the exercises for each lecture.
Yes, this is the right answer. So you just need to look at the exercises we will do together. So if you study, you will not have any problems, guys. This is definitely okay, so other questions? Good. So this is the syllabus, and then I'll just show you what I uploaded. Okay, for these modules, I don't officially, okay, we don't require any previous knowledge. But my suggestion is, if you don't know what a linear regression is, if you don't know what a t-statistic is, please have a look at the folder that I uploaded in Dropbox. So if you go here there is a folder preliminary knowledge. So basically what I've done here, okay, this is a chapter from this book. Okay, you can find this book also in the library if you want. If you don't have the, let me make zoom. Okay. Can you see it? Okay. So this is a very simple book of econometrics. So, but you can use also other simple, other books that you can find in the library. I can also suggest you other titles if you want. So, if you don't have really any knowledge of basic linear regression, just have a look at the chapter number 3 of this book, or an equivalent chapter from other books that cover this topic. Why? Of course, in the exam, this is not a module of econometrics. So I will never ask you to do, I will never test you, I will never test your econometric skills, because it's out of the scope of this module. But if you want to really understand everything of this module, and then if you want to understand the other modules that you will do here at the University of Southampton, my suggestion is to have a look at this chapter. Here, in any case, I cannot scan the pages of, because it's a uploaded here the slides. The slides of the book are very, I mean, you can get many information. So if you have a look at the slides, you can also get the idea, okay? You just need to get the idea. In any case, not the next week, the week after, we will start to analyze a number. We will do some analysis also together, and I will try to explain if you don't understand, if you're not familiar with some basic concept, I will try to help you. But as I said, I cannot explain. If you really don't know anything, you just need to use chapter. Okay? How many of you are studying quantitative finance? Okay, so you should be able to, I mean, you're doing this kind of stuff. Okay. You will do. So this is the future. So we will go more. But for my modules, you just need to know some basic stuff to interpret, to understand the meaning of some analysis. Okay? But I will help you in any case. So please, guys, have a seat or go out. What do you want to do? Okay, then, so to go to here, also in preliminary knowledge, you have some later today, so we will cover, how many of you have studied Introduction to Portfolio? Okay, so I will cover this afternoon and the next week some part related to the portfolio, because we need to introduce some concept to then analyze, to then do the stock market analysis. So we will do some part together again. It will be more practical. So the next week, compared to the module of Introduction to Portfolio, I will give you real data. We will do some analysis together. So I will make sure that you will fully understand what an efficient frontier is, optimum portfolio, blah, 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 blah. We will cover this part this afternoon, eventually, and the beginning of the next week. So the next, yeah, and then we will keep on doing other stuff. Of course, I can adjust, let's say, if you need to have more exercises, if you want to have less exercises, if you have some doubts on a specific topic, please let me know so that I can include more materials. So what I wanted to say that this is the materials that I will use is very similar to the one from the previous year, of course, because the module is the same. But depending on your request, I can also include more exercise of different things. Okay, so of course not for one student. If you have really doubts, come to my office hour. Okay, otherwise, if many of you want to have more, I don't know, more stuff, I can always include it. Okay, so in this part here, portfolio mean variance and covariance. Let me see what we do here. But there is I uploaded many, in this case, I think that I don't remember. So this is I took some exercises from the second chapter of, from chapter number 4. Good stuff. Good. So from chapter 4, you should find here some. No, chapter 4. No. Shouldn't trust. Never trust. I think that maybe you number 4, did you open this folder? Did I scan also some pages? Yes. I scanned pages of the book. Okay, so there you should find the exercises, and also I scanned the pages of the book. Okay, so you, because I know you are 140 students, so how you can, in the library there are few books. So in this case, I scan also the pages of the book. Okay, so you can read, you can practice, but don't worry, the next week we will do also some analysis together, so we will do some stuff together. Okay, just go very fast to the syllabus and then we start. It's already started. Do you have any questions? Questions for this part? Any doubts? No, good. Okay, so syllabus. So what we will do? Okay, the first part is just an introduction. So what I will cover today pretty fast. I will introduce you with an overview of what are the how the securities are traded, definition of real assets, financial assets, buy on margin, short sale, something that you should be, maybe many of you already know, but I must be sure that you know this concept. Then we will do, so I will provide you some information on how the securities are traded and how to calculate the stock index, the return of the stock index. So this is more or less the topic of the next that I will cover the next hour. These are the learning outcomes. So at the end of this first class, you should be able to know the characteristics of asset class and financial instruments, know some information regarding investment process, and understand the key elements, so also the main actors involved in an investment process. Later today, we will discuss something related to risk and risk return of assets, and I will start to cover this part here. So we will go through the definition of risk aversion, capital allocation to risky assets, definition of minimum variance portfolio, optimum risk portfolio, optimum complete portfolio, definition of the efficient frontier. So here you have the description of the learning outcomes, and I will repeat at the beginning of the next class. At the end of each class, you get also the reference for the chapters. So you can study the slides, and if you study the slides, you should be able to pass the exam. So if you study the slides and you do the exercises together with me, no problem. But of course, the book, you can use the new version or the old version, of course, including more details. So if you want to get more information, read the books. Okay, so the next week we will do this case study. So it's a case studies on gold. So we will look at the diversification of the portfolio and how an investment in gold can affect the performance and the risk of your portfolio. For this specific case study, the next week you have to bring with you your personal computer. Okay, computer. And eventually you can also share a computer with your friends. So if you have friends, you don't need to bring one of your computers. You can just bring one, okay? But what I ask you to do at least we will do this part. Then I will do the single index model, capital asset pricing model, and again we will have arbitrage pricing theory, multi-index model, and again we will have another case study. Also for this case study you need to bring your computer because we will do some analysis together. Okay? So here in Blackboard, you already have the case study and you already have the data. Okay, so then I will ask you some questions, we will do some analysis together, and you have to do this exercise, answer the question. Then efficient market hypothesis, behavioral finance, just few information technical analysis. Then if there is time and this depends on your knowledge, I can also cover the models. I mean, I will add eventually some other materials relating to the index, some index that you can use to measure the performance of the portfolio. So, mobile, no. Okay, here you find all the information. I will also give you some journals to read in advance, not the next week, eventually in 2 weeks' time from now. So I will upload it this weekend, so you can have a look and then we will discuss together. Okay? So this is the syllabus. Here there are the case studies. So here if you try to click on this link. Okay, so if you click on this link, as you can see, you will have your case study. So here there is the case study that you have to read in advance, and here you will have the Excel file for your analysis. Okay, just open them so you know. So as you can see here, you have some data. And then here we will start to apply, okay, the theory that we will study together to do the analysis of these assets. Okay, together. Okay, let's start now. 9:31. So do you have any questions? These are the slides as you can see from the previous year, because it's an introduction, it's never going to change. So do you have any questions regarding the syllabus, case studies, or other things? Question? Question? Okay, we can start. Okay, so here I just provided with a short overview of the main concept so we will go through the definition of the main financial assets, and then we will do some exercises together. You will do, and I will check if you do properly the exercise. So first of all, when there is an investment process, you have to keep in mind two main problems. The first one is relating to the choice of the assets. Which asset do I have to include in my portfolio? The second one is basically how to monitor, how to manage my portfolio. So the first one is how to choose my assets. Once I have chosen my assets, how can I keep on monitoring the performance of my portfolio? So as we will try to understand, we will try to answer to this question with this model. So first of all, we need to keep in mind that there are two types of strategy, okay, that you can pursue when you manage a portfolio. An active strategy is when you basically you keep on balancing your portfolio. So you try, let's say, to identify which security are mispriced, and then you try to understand when you have to buy and sell these assets in order to get a high performance. The other type of strategy instead refers to the passive management strategies. A passive management strategy is a strategy where you basically don't try to understand which are the security under evaluate, and so basically you don't try to beat the market. So one question, And how you can do, since you want to, let's say, reduce the risk of your portfolio, you try to invest in many, many, many assets. So instead of putting my money in a unit basket, I invest in different, I buy from different people, because of course, if something is going to happen to one person or to one asset, then the risk is going to be lower because I diversify my money in different assets. But we will see the property of diversification later today and the next weeks. So, if you believe, so if you are pursuing a passive management strategy, this means that you don't invest time and money in fundamental analysis. Fundamental analysis is the analysis to understand through the analysis of the balance sheet which assets are under evaluated. So this means that, for example, this book, the price is 100, then I start to, as an analyst, I start to look at the, so I start to look at the quality of the paper, then I realize that this is a very good paper or whatever. So the actual price can be 120. So what I do as an analyst, I try to analyze the quality of the firm to then come up with the right price. Of course, this is time consuming and also is also requiring money, time and money, expertise. In the other case, also with technical analysis, so through the analysis of the past performance, so using also historical data or looking at the trends of my stock, I try to identify whether it's convenient to buy or sell the stock. If you said this is so, fundamental analysis and technical analysis are for active management strategy. So if instead you don't believe and you don't think that you can identify stocks that are overpriced or underpriced, in that case, what you should do? If you think that you cannot beat the market. So if you think that the price in the market are the right one, what do you do? Where do you put your money? So I think that there is no way for me to discover the right price of an asset. So what's an example of passive strategy? What will you do if you think that you cannot beat the market? Yeah?
I would buy ETFs, exchange trade funds, because they mirror the performance of the market, and you don't have any expenses or very low expenses in order to buy the fund. So you don't have any expenses on the one side, and on the other side you have all the performance from the market.
This is a good answer. So basically you can invest in the index or in funds that invest in index, because you cannot beat the market. You want to reduce your risk. You need to invest the money in you need to have a portfolio very highly diversified, so you put the money in the index. That's it, because you cannot beat them. You cannot beat the market. You think that the price in the market is the right one, so why wasting time, why wasting money? So when we refer to passive management strategies, we are referring to strategies that aimed, so that the scope of this strategy is to replicate an index. So you can directly invest in index, or you can invest in other funds that instead replicate an index, so you don't waste your time and money. Of course, there are three types of financial assets, so all the time we will do many exercises together, and all the time we will have a portfolio with fixed income, common stock or equity, or sometimes also derivative and securities. These are the main. If you don't see, let me know, okay? If you you don't understand, just stop me. Okay? If you don't do, I will become very angry. If you do, I will be very happy. So, these are the three types of financial assets. So more or less, if you want to think about the structure of what you can find in the market, you have two main categories. The first one is direct investing. Okay, so you put the money in money market instruments, capital market instruments, derivatives. And when we speak about capital market, you need to keep in mind that in the capital market you can find fixed income instruments and equity instruments. Or otherwise, as your colleague was suggesting before, you can also invest your money indirectly, so you give your money to some funds, mutual funds or whatever, and you let them invest the money for your behalf, on your behalf. For you. Faster. So when we speak about money market, first of all, what does it mean? So money market, you can find all the short-term. So first of all, is an investment in the short period. So you need to borrow money in the short period. So short periods from, for example, if you go to the treasury bills, you go to the you borrow the money from the treasury. So this means, sorry, you are lending the money. So in this case, what does it mean? That in this case, you have an investment in the short period, very low risk. So when we refer to these instruments, we refer to low risk instruments. One of the instruments that you can find in the money market is the, for example, treasury bills. How can I activate it? Why? If I don't touch it. So these are the most marketable of all the market instruments. The government raises money by selling bills to the public. So the government sells the bills, you buy it, and then you receive some interest on it. This is it has a different maturity for 13, 26, 52 weeks. So as you can see, it's a very short-term investment. And many of these securities are traded in large denominations, so a huge amount. Okay, it means a huge amount of bills. Other types of money market instruments are also the LIBOR. What's the LIBOR? Do you know what the LIBOR is? What? Tell me the definition. One, the guy with the green shirt.
London interbank operating rates.
Good. So this is the interest rate to exchange funds between the banks. Then we have other type of money markets, for euro fund rate, euro-dollar rates. So and then you have also, if you go here, you can see what I've done here. So if you want to get we can also click on the strategy. So here I scanned the pages of the book where there is some there is the description of, I scanned the pages where there is the description of the most common money market instruments that you can find. So there are the commercial paper, certificate of deposits. So commercial papers are very common among large institutions that have a very solid rating, so very good reputation. So instead of borrowing the money directly from the bank, for example, large company can issue commercial paper, so they need to get money on the short term, for example, to pay payroll. So the banks, the companies doesn't have the money to pay the payroll, so can issue the commercial paper, do not have any collaterals. So this means that it's a pretty risky investment, and only, as I said, a large institution with a very well reputation usually issue this kind of instruments, because you know that they will be able to repay, then to repay you the money. And usually what you do, they issue this commercial paper, someone buy the commercial paper and give the money to a large institution, and then they they then refund the money, including an interest rate that they provide to public people. And here you have other certificate of deposits, are another type of money market instruments. These are time deposits. They cannot withdraw on demand, and again they provide interest rate investments in a short period. So all the time that, and that is also another thing. Yeah, there are some examples of how the repo market works. My question is, if you look at this graphic here, okay, what can you understand from looking at the graphic? So here basically you have the spread between 3-month CD and T-bill rates. So this is the spread between the interest rates of these two guys. CD and T-bills. So looking at this graphic, what can you get? Which information can you get? This is also the description. This is the difference between the interest rates of the two guys. What I understand. What does it mean, this peak? Credit risk, market crash. So if the spread increase, what does it mean? This means, looking at this graph, what you should get is that in any case, even though in the money market you find a short-term, you have an investment in the very short term, and with a low risk profile, there is still risk, as you can see. So this is what you should get from the interpretation of this graphic. As you can see, the spread between these two different instruments in the money market, the CD, certificate of deposit, and treasury bills, increase when there are crises, shock. Why? Because these rates reflect the default risk, the risk that an investor is facing, investing the money in one of these assets. So this means that when we speak about money market, this doesn't mean no risk. There is risk, because there is a default risk. So keep in mind, why I'm telling you this right now, because in all the exercises that we will do later, we need always to have a risk-free asset. And we will take as a risk-free asset the treasury bills or an instrument from the money market. But keep in mind that there is still a risk. Okay, this is what the graphic should tell you. And there is a different default risk between different instruments in the money market, and you can see from this peak, when there is a crisis, the interest rates and the spread between the two instruments increase. When we speak about capital market, instead, so we are in another type of world. Sorry, if you want to get more information and look at different types of money market instruments, you can open the PDF file that I scanned here. Okay, you can read it. But for the exam, I will never ask you what a certificate of deposit is. This is just, okay, preliminary introduction or something like that. But have a look if you don't know what it is. So for the capital market, in this case, we are speaking about long-term finance investment. We have funds with a maturity higher than 1 year. So before we were speaking about weeks. Now, here, at least. And then when you can buy and trade this type of assets in the primary and secondary market. You have 2 types of instruments that you can find in the capital market, bonds and equity securities. When we speak about bond, basically in this case we are, the main, this is very simple, general notions require the issuer or the borrower to repay the lender and investor the amount borrowed, plus interest on a specific period of time. So when you invest the money, of course, in the bonds, you are a borrower. So you give the money and then you get, you need to pay interest rates. You can have fixed income, so you have to pay coupon every 6 months or a different type of deadline. You have different type of instruments. You can have short term, 1 5 years, medium term 5 12 years, long term higher than 12 years. And within these categories, you have different type of bonds, so international bonds, corporate bonds, and so on. So remember that when we speak about bonds, we are speaking about debts. So the issuers are borrowers and the holders are creditors. Okay. Of course, the coupon rate can also be 0. In this case, coupon are interest that you pay with some frequency, semi-annually or whatever. And if the coupon rate is 0, in this case, investor returns come in the form of price appreciation. So the price is going to be increased. And this is how you get the money if you are a creditor. The face or the par value is typically $1,000. This is the principal return opportunity. And here you have some different type of bonds. You have callable bonds, bonds that can be purchased before the maturity date, convertible bonds, bonds that you can convert in the stock of common stock of company. Putable bonds, they give the bondholder the option to retire or extend the bond at the call date. Floating rates, this means that in this case the coupon is adjusted depending on an index. So for example, the right might be adjusted annually to the current deal rate plus 2%. And so on. So this means that there is no fix, you don't pay the same coupon, but change depending on the index based on which you calculate your rate, coupon rate. And then so on, you have many others. You have catastrophe bonds, index bonds, general price commodity, and other. As we said, when we speak about capital market, we have bond, equity securities. We make a distinction between common stock and preferred stock. With the common stock, you take ownership of the company. Residual claim, this means the stakeholders are the last in line of all those who have the claim on the assets and income of the corporation. Limited liabilities, of course, the risk that you are facing as an investor is to lose the money that you invested in a company, but you don't lose more money of the money invested. In the other case, instead, with the preferred stock, you acquire some rights, you can receive dividends. So you have the rights to receive dividends, and then in case of failures of the company, you should receive the money back from the company before the common equity stakeholder. Tax treatment, they are not tax, you cannot deduct the tax expenses. This eventually can be a disadvantage. And finally, if you remember the 3 assets that we have derivative markets, and here you have many type of instruments, you have options, they give you the right to buy or sell an asset, a security at the maturity, or before the maturity, depends on the option that you are buying. When you buy an option, you pay a premium. The premium is the price of the option itself. So basically, you buy this option, and before the deadline, or before the deadline, depending if it's a European or American option, you can buy an underlying asset. Okay, so this means that instead of buying directly an asset, so instead of buying this water, okay, right now I can tell, okay, I buy the option to get this water at a fixed price that I establish now at the end of the day. Why I don't buy directly the bottle of water? Because I think that the price can go up or go down. So in this case, I think that the price can go up. So I need, in this case, why? So instead of this water now, so I said, I want to buy at the end of the day this bottle of water for £1. Okay, and to buy this option, I will pay 5 pence. So if at the end of the day, the price of this bottle of the water is going to be £1 and 10 pence, at the end, I will use my option for 5p, and I will get this bottle of water for 100, and the value is now 110. So I can sell and gain 5 pence. So this is why, in this case, you are betting that the price is going up or down. In the case of a put option, what I do, I buy the option to sell something at the deadline. Why? Because I think that the price is going to be down or up? Down. So I buy the option to sell something at a fixed price because I think that in the future the price is going to drop down. So I can sell the bottle of water that has a value of 90 after 1 week for 100. So I can gain I can gain 10. Of course, minus the premium that I paid. So in the case of future, in this case, you are you buy an obligation to make or take a delivery. Long position must buy at the future price. Short position must sell at the future price. Future contracts are entering into without cost. So in this case, again, it's again a bet. You buy the right. You basically it's worth that you can take a long or short position to buy and sell some price, and then all the times that the price increase or decrease with respect to the fixed price, then you gain money or you have to put money. Potentially you can lose, while with equity investment, you just lose the money that you invested. With future investment, you can lose infinitive money, eventually. But you will study, I would suggest you to, we don't cover then, I think I will upload some slides on the option in future if you want to get more information, but if you want in the second semester, there is a module on derivatives that you can study. So, then there are the swap. Swap is another, again, goes within this category. And here there is an example how you can, this is an example of interest swap. So just to let you know how you can basically transfer, how you can gain from this type of instruments. But right now we'll make a stop of 10 minutes, then we go to this example briefly, and then we will do some exercises. I will go to some. But let me finish this and then we'll do the stop 10 minutes. Yes, and then we do the exercises. Yeah. This is a very simple, maybe you you can also have a look by yourself. This is another example how it's working with the interest rate. Simply keep in mind you have two types of firms, firm A and firm B. So suppose this is the payoff. So they can borrow money and firm A at a fixed rate of 15%, or otherwise with a floating rate LIBOR plus 3%. Firm B can take the money for 12% of LIBOR plus 2%, so they can reduce basically the interest rate that they have to pay just doing something like that. So this means that the firms A, in this example, want to raise 10 millions through a fixed coupon rate. The firm B wants to raise 10 millions through a floating rate coupon rate. So what the firm A can do, can go to the market, borrow the money at LIBOR plus 3%, and then make an exchange with the company. So let's say the company can say, okay, I give you 11% minus LIBOR, so the final payoff is going to be 14%. The firm B instead want to raise money at the floating rate, so can go to the market, borrow the money at 12%, and then again make an exchange of interest rates with other companies minus 11% plus LIBOR, and at the end the payoff of this company is going to be LIBOR plus 1. So as you can see, this is what they can get from the market. Through an exchange of interest rate among companies, they can reduce the actual interest rate that they are going to pay for the same amount of money that they are going to borrow. And here it's just an example. So they go to the market and they get this money, and then they swap 11% and LIBOR. So at the end, this is what they could get from the market. At the end, after this operation, they can reduce the effective interest rate that they're going to pay for a borrowing operation. So just to summarize, derivatives you use to transfer the risk. Common stock is equity or ownership in a corporation. Payments to stockholders are not fixed. Fixed income, you have payments fixed or they can necessarily, in the case of floating rate, depending on some formula, some index. You have money market debt, short term, highly marketable, low credit risk, capital market, long term, instead more risky. Let's stop now 10 minutes, so this means that at 12 we start. We will go through the exercise of the stock market index, buy on margin, short sell, and then we will finish this part. And then we will start immediately the next 2 hours to cover what we have done with the introduction to